Yep.
Hey, this is Warren Redlick. I am here with Mayur Thaker. He is somebody that I rely on a lot for his views on analyzing stocks, in particular Tesla, also Beyond Meat. We just did an interview recently with Plant Stock about Beyond Meat and other topics related to that. We were talking on Twitter about the possibility of Tesla doing a stock buyback. And I wanted to bring Mayur on to get his take on whether Tesla should do a stock buyback, what it would mean for the company, what it would mean for shareholders, and so on. So we're going to get into that. Are you ready? Let's go. Before we get into that, would you please tell the audience a little bit about yourself?
Yeah, sure. So I work as an analyst at a firm called Zacks Investment Research. It's a
I've heard of it.
full firm. Yeah. So we provide data systems to institutional portfolio managers and analysts, kind of like a Bloomberg or a FactSet, right? So
I
we've all
think I think on Fidelity Investments, I have an account on Fidelity Investments. I think I see Zacks Investment Research as
yeah
one of the options for research for stocks.
yeah
Okay.
yeah exactly. So I've been working basically with professional portfolio managers and analysts for the past 15 years or so. So I kind of have a exposure to the type of thinking that Wall Street has when it comes to picking stocks.
Okay. And real quick before I get in any further, don't forget the Elon stainless steel water bottle and the Discriminate Cogitande, which means critical thinking t-shirt on elonbits.com. So there's been this talk about a stock buyback. The stock price is low. Tesla has a big cash pile. Some people think it makes a lot of sense. Use some of that cash pile to buy back some stock. What do you think about Tesla potentially doing a stock buyback?
Yeah, so this is kind of it attracts a lot of wide sentiment. People think that when they hear the word stock buyback or dividend, it means that the best days are over, are behind us, right?
I hadn't heard that. Why?
Well, it's because the idea of a stock buyback is associated with companies that are basically done and dusted, like in terms of their growth. So once growth starts to slow down for big companies, then it's like, what do we do with our cash? Well, let's just start paying a dividend because we have no other, we're fresh out of ideas. So it's time to start paying our shareholders now.
Okay.
So, that idea is associated with, that type of company that's at that sort of terminal phase in their life, right? I believe that Tesla should start doing a buyback. But that doesn't mean that Tesla's best days are behind them. And here's why. So, if we look at some of the data, and I'll just, share my screen here so we can see some of that. If you look at the data on, the evolution of Tesla, they went from, a net debt position to a net cash position. So what does this mean? This chart is telling us that they are now at a net cash position in the amount of almost $13 billion, slightly more than that. This is basically cash on the balance sheet minus their total debt that they owe. So, in the early years of Tesla, back when they were, cash burning and they were still very heavily leveraged, right? They had a lot of debt on the balance sheet and they burned cash. So that kind of attracted the whole Tesla Q movement, right? Thinking that this is going to be the death of the company because of huge unprofitability, cash burn, and a lot of debt on the balance sheet. And obviously, we all know what happened after that. They went to free cash flow positive, and now that number is well above $13 billion. So Tesla's gone from cash burning to hugely cash positive, and that number is growing over time. Now at 13 billion plus. I believe that this is going to continue to grow. Why? Because of this number, they're positive and increasing free cash flow. So what is free cash flow? Free cash flow is the amount of cash that's left over after the company has met all of its ongoing routine expenses and all of its growth spending too. So this is net of all of their capital expenditures that they have spent on Gigafactory Shanghai, on Gigafactory Berlin, on Austin, on the 4680 pilot lines, on the supercharger network, on their service center growth, on everything combined. So after all of that growth spending has already been, has hit the books, they're still generating positive free cash flow by over $4 billion on a trailing 4 quarters basis. And that number is only going to grow. And how do we know that? Well, because in the future, this is their actual guidance. So on the 10K, they're telling people, they're basically telling us that, look, we're going as fast as we possibly can. We're investing in the Model X, Model X, S, Megapack, Solar Roof, ramping manufacturing facilities on 3 continents, all of that. And despite all of that activity, they only need about $5 to $7 billion a year in total capex, right? They did over $14 billion in operating cash flow alone over the past 4 quarters, and will need only about 5 or 7 billion in capital expenditures for the next 2 to 3 years. So that means that even if Tesla did not grow at all for the next 3 years, their operating cash flow just stayed the same as it was for the past year, they would still be generating positive free cash flow by almost $7 billion per year, which means that this chart will just continue to rise. What that means is that their cash pile is just going to keep growing and growing and growing, right? Even though they're spending as fast as they
Okay,
can on growth.
but how much cash does Apple have?
It's in the hundreds of billions. I don't know the exact
Right.
number.
So Tesla's far from having as much cash as Apple has. So isn't
Yeah.
and I think the concern is if Tesla's just building factories, they're very efficient at building factories, so they won't use enough cash. But isn't it possible that Tesla's going to do an acquisition of like a mining company or something to secure their supply chain? And those acquisitions might end up being a large amount of money. If they use the money in a share buyback, and then that's money they can't use to acquire a mining company or something similar.
So that would be awesome, right? So let me preface this by saying that I actually would prefer Tesla go out and invest in factories and in mining and to secure the supply chain. Why? Because Tesla is getting exceedingly efficient at capital deployment. So this chart tells you their cash flow return on invested capital. So I always talk about this concept of ROIC because it's very, very important to understand how efficiently a company is generating returns per dollar of capital that they deploy into their business. And we can see that during the cash burning years, obviously it was negative because they had negative operating cash flow. And that number has dramatically improved ever since the ramp of the Model 3 and Model Y, and has gotten even better as Gigafactory Shanghai has come online. And this rate of change, I think, is going to continue for some time. So this is already north of 30%. So this already puts Tesla in a league of big tech. The companies that are able to do this are NVIDIA, Apple, Google, Microsoft. These guys are the ones that are generating 30% returns on capital. So Tesla is the only auto manufacturer that's on that list, right? No other auto manufacturer is doing anywhere near this. Even if you forget about their EV programs, they're not doing 30% ROIC on their legacy gas cars. So, Tesla is in the league of big tech, which means that the best use of capital would be to invest in gigafactories and in service centers and in superchargers and all of that, and mining companies to secure, all of the materials that they need for, building batteries that
I
they.
just remember, I don't know if it was the Q1 investor call, Elon was talking about trying to get people to produce more lithium and saying that the spot price for lithium now is 10 times the cost of mining it. And that's where it would make sense for Tesla to say, you know what, these other mining companies aren't getting there. Let's go ahead and buy a lithium mining or refining company. And we can probably do it better than they do it anyway, because Tesla engineers always find a way of doing something better than the way it's been done. That seems to me like a more sensible way to spend the money. What do you think of that?
Well, I definitely agree with that, but I think that's already being anticipated in their forward guidance, though. Because I mean, think about for the next, what they're saying is they need somewhere between 5 to 7 billion in 2022 and each of the next 2 fiscal years. So I think by 2023, 2024, you would think that Tesla is making moves in this direction. So based on this guidance and, based on what they have done in the past, it seems like all of that is already being anticipated in this number, in this $5 to $7 billion number. So that tells me that, there's two
I
edges.
see your point. You're saying They don't expect to spend more than $7 billion in 2022, which means they're not going to make an acquisition more than $7 billion worth in 2022. So their cash pile is going to continue to grow. But there's plenty of room for their cash pile to grow. And they may be thinking, we're going to have to make these acquisitions over the next few years. And we want to have that cash pile ready so we can do what we need to do.
So if that's the case, then yeah, I would fully agree that, yeah, I think that they should not do a buyback then. But I just don't see any evidence that that's actually happening.
So what is the gain to the company from doing a buyback?
So for long-term shareholders, a buyback is the best way for you to grow your ownership in the company, right? So if you and I don't sell a single share of Tesla for the next 10, 15, 20 years, then, and even if we don't add to our position, our shares are becoming more and more valuable because the pie is shrinking. And yet you're keeping all of your shares the same.
Well, let's say it
Each
this way.
share,
I think there's, what are there, a billion shares float, roughly, something like that?
yeah, slightly above that, yeah.
So if they buy 100 million shares back, then there's 900 million shares instead of a billion shares. The company still has whatever value it has. As it grows, it's going to have higher value. And now we, instead of owning, we now own a higher percentage of the company.
Exactly. So the earnings per share, goes up, and it actually reduces volatility in the stock too.
Well, like, I mean, if you and I think the stock's going to $10,000 a share, and Tesla can do a share buyback today at $700,
Exactly.
well, then
That's a great return on the investment.
then you and I are making a killing.
Right.
Right.
Yep.
Okay.
So it actually helps the stock price because earnings per share on a per share basis goes up. So you and I own a greater percentage of the company over time as the share count decreases. So companies all across the board do this. Like you mentioned, Apple. Apple has a huge cash pile, right? But that's why they pay dividends and they buy back shares. They do both. I don't even want them to pay a dividend. I think a buyback is enough. And like Warren Buffett is a big fan of buybacks himself. Berkshire doesn't pay dividends, but they've been buying back shares for years now. So for long-term investors, it actually encourages long-term investment, not trading, because it only the biggest gains accrue to long-term shareholders, the ones that are holding for 10, 15 years or more. So, I personally think that, Tesla, their capital deployment is just phenomenal. But I think they're hitting a sort of a good to have problem, which is that they can't deploy the capital fast enough. And that's the biggest issue that I see with Tesla right now, is that they're just not able to deploy fast enough. This chart right
All
here.
right. I got another thought.
Yeah.
2023, they build robotaxi factories. 2024, they start producing robotaxis. And rather than deploying those robotaxis, selling those robotaxis to customers, they keep them and put them in their own fleet. And so they start accumulating robotaxis. Maybe the robotaxi network isn't live yet, but they start accumulating robotaxis, and it costs them $20,000 a robotaxi to build them. They build 1 million of them. That's a $20 billion investment. So, I mean, I could see that being a way that they're going to deploy capital, which ultimately ends up producing even more crazy cash flow, because once the robotaxi network goes live, it's a big cash cow. But maybe that's part of the plan, is that they're going to invest in building their own robotaxi fleet. What do you think of that?
That could happen, but remember, they're going to be hugely self-funding. They're already self-funding now, but the extent to which they're generating positive free cash flow is going to be much, much higher than it is even today by 2024. So by 2024, I mean, you could easily envision, if they don't do any buybacks or do nothing, I could see their net cash at double where they're at now or more. They're already doing 4 billion in free cash flow just over the past 4 quarters.
But I think
and
you just
that's going to grow exponentially.
But I think you just said that Apple has a really big cash pile. So is it bad to have a big cash pile?
It is if you're not deploying it, right? If you're not deploying it,
right? But I mean, Apple's not deploying their cash pile.
Well, that's why they're paying a dividend, and that's why they're buying back stock as well. So they are starting to redistribute that cash, back to shareholders now.
But I mean, but they let it go to hundreds of billions. Tesla only has 18 billion in cash. Maybe it makes sense for Tesla to let it run up to 100 billion before they start worrying about it. Is there a threshold where you start worrying we have too much cash, and maybe 18 billion isn't there yet?
So this happened. So if you go back into the history books, so Microsoft did this for a while. In the early 2000s, after the dot-com bubble burst, right? And most companies went bankrupt, but the ones that were actually serious, remained standing. And Microsoft obviously was one of them. And they were generating massive free cash flow, in 2000, 2000, 2001, 2, 3, 4, 5. And what they were doing is they're just sitting on this cash. They were sitting on a gigantic cash pile. I think it was actually almost, I don't want to misspeak, but it was a crazy, ridiculous number for $2005. And they were just sitting on this cash doing nothing but investing it in treasuries. And investors were like, well, what do you guys plan on doing with all this cash? Right.
Right.
And there was an entire shareholder kind of revolt against it because all they were doing is investing
Right,
it.
because the theory is if you return the cash to the shareholders, then I can invest where I want to invest, and I can look for other companies to invest in that are going to give me a better return than treasuries.
Exactly.
And that's the concern. But
Exactly.
if Tesla is a trillion-dollar company and they have an $18 billion cash pile, that's 2% of the company's net worth. It's not significant. If Tesla all of a sudden has a $500 billion cash pile on a $1 trillion valuation, which of course the valuation would go up if they had $500 billion in cash. But if Tesla ends up with a higher, at what point does the cash pile to market cap ratio, is that, I mean, is there any sound thinking on when your cash pile is too big for the size of your company?
So it's usually done on a ratio basis. So this is what credit rating agencies do. Is one of the ratios that they look at
This is
in
what
assigning a
wait,
credit
just
rating.
to be clear, what credit rating agencies seem to do is they seem to place a company that has a huge growing cash pile and nearly zero debt
Right.
as a junk bond company, and companies that have massive debt and declining revenues as investment grade credit ratings. But I'm sorry, I'm
That's
just picking on the fact that the credit ratings agencies are not fair to Tesla. But I'm sorry, go ahead.
No, I completely agree. They're useless basically.
Yeah,
Like these three
but
charts alone should be enough to be investment grade.
yeah,
But this idea of how much cash you should really have depends on your level of profitability as well. So it's kind of like a net debt to EBITDA type ratio. So investment grade companies usually are somewhere below two times, right? So that's the multiple that most people have in terms of cash to debt to EBITDA.
yeah.
So the bigger you are, the more cash you can keep on your balance sheet because of, net working capital needs and things like that. So, but yeah, at some point, when your cash just grows to such an enormous level, it makes sense to either tell shareholders that, look, there's a reason why we're keeping this cash, and here's the reason why. Or if you don't have a reason why, it's time to start, thinking about, giving some back to shareholders. Not all of it, not even half of it, but some of it, or at least initiate a small program and then grow that over time. And that's why companies are able to, grow their dividends over time, even if there's recessions, because they paid a very tiny percentage of their cash or free cash flow out as a dividend or as a buyback. So even if there's a recession and your profitability drops, you're still, paying a very small percentage of your total cash out. So you can
Right.
continue to do that. So that attracts a whole new sort of, type of investor into the company. Institutional investors that, like share buybacks.
All right, let me make another argument against the buyback. So the other argument I can think of against the buy, I mean, I could see, like right now, I'd say, all right, let's say we have an $18 billion cash pile, and I believe it's a $1 trillion company. The $18 billion cash pile is trivial. The other the That's one of my concerns about, when the cash pile gets big enough, then I'll worry about it. The other concern I have is we may be heading into a recession. Elon certainly thinks we're in a recession or heading into a recession. In a recession, is it valuable to have a cash pile? Now, I would say in an inflationary recession, maybe cash isn't something you want to hold. But if we believe we're in a recession, is it good to have a cash pile to protect yourself in the event that something bad happens that's unforeseen? And
Sure, but
is
they have that, right? They've got that now.
well, maybe it's not big enough. I mean, maybe you want to have a bigger. There's, I think the thing is, until your cash pile is so big that it becomes a really significant portion of the company's market cap, 20% of market cap instead of 2% of market cap,
Mhm.
then maybe there's so much ups. There's not much downside to having a large cash pile. I mean, I still haven't heard from you. What's the downside of having a large cash pile other than that you want to let investors be free to invest the cash themselves more efficiently?
Well, remember this helps the stock price. This is not something that is in you and I as long-term shareholders shouldn't be
Okay,
indifferent to it.
wait. So helps the stock price. As I see the role of the company, the real role of the company, the way I see Tesla manages, we're trying to accelerate the transition to sustainable energy. And raising the stock price doesn't accelerate the transition to sustainable energy. We're trying to produce cars in volume. We're trying to produce batteries in volume. We're trying to produce Megapack Powerwall in volume. We're trying to produce solar panels. Having that cash pile on hand, you never know when you're going to need to take some extra cash to spend it on something. And that value of having that cash ready to use, ready to deploy when you need it to make an acquisition. Suppose they decide to do a $10 billion acquisition, right? We
That
don't
would be,
know.
yeah,
And maybe they want to grow the cash pile enough so that they're ready to make a $50 billion acquisition.
yeah,
And even at a $50 billion cash pile, that would still be ballpark 5% of the company's market cap, or maybe it's, 6% today or something like that. That's still a fairly small. So, the fact that I'm only earning treasury rates of interest on 6% of the company just doesn't really get me worried. But having that cash pile available to, and we know, like Elon has said, there's going to be this master plan coming and it's all about scaling manufacturing. And we see that there's, issues in the supply chain. We see that there's issues with raw materials. They've talked about getting lithium from lithium clays in Nevada. It's very clear that they were talking about nickel before. Now it seems like lithium's a bigger issue than nickel. It just seems to me like they've got a lot going on here and they're going to need that capital for something. So having the cash handy is more important than the buyback. Okay, the value of my stock goes up. I'm a long-term
remember,
investor.
this is not at the expense of doing all of those things that you're saying. Remember, I fully agree. Look, I mean, the numbers don't lie, right? This ROIC chart tells you that for every dollar that they invest in the company, they're generating 32 cents back
Right,
as cash flow.
but
So that's awesome.
if you have cash free to deploy, it makes acquisitions easier. If you do a share buyback, you can do an acquisition with shares, but a cash acquisition is generally, I think generally speaking, a cash acquisition is easier to do.
Oh yeah, yeah, for sure.
So I think the flexibility of having a big cash pile allowing you to make acquisitions as needed is more important than a sort of artificial juicing of the stock price.
If that's in the plans, I mean, I'm all for it, right? But I mean, just judging, the history of the way Elon works, I don't know. Maybe he'll do it at some point in the future, but he kind of likes to build things internally rather than going out to make a big acquisition.
Right, but
And they've made small acquisitions.
you can't really build a mining company internally. Maybe you can. I don't want to put anything past Elon.
I think they actually are trying to do this internally, at least for lithium.
Right. Well, they talked about it. That's one thing we haven't heard is, what's the status of the lithium clay mining operation in Nevada? And that probably is a good question for the Say Technologies Q&A question for the next earnings call is, hey, what's going on with lithium clay mining and Nevada?
Yeah.
I actually think we should gang up. A group of us should gang up and like identify what questions we want to ask and be on top of things when we can't publicly as YouTubers promote our questions, but we can talk internally amongst ourselves and network with people and saying, hey, push this question.
Yeah. I completely agree. Yeah. I mean, look, I'd be all for it if Zach said, "Hey, look, I know I guided for 5 to 7 billion. on the 10K, but we actually need 10 to 15 billion for each of the next 3 years.
Well,
I'd be
is
I'd be fine with that. And I'd be like, all right, forget about the stock buyback idea. Let's do that.
what is
Right.
when he talked about the 5 to 7 billion for capex, if they do an acquisition, isn't it possible that that's really outside the 5 to 7 billion they identified?
Um, that could be. Yeah, that might be. Because they did say that this is capital expenditures, which is in the same category as acquisitions are.
Yeah,
But that's actually kind of a tough question. Yeah, it could be. It could be separate. It could be on top of that.
yeah. I just,
Yeah.
the need that they have for nickel, the need that they have for lithium, the need that they have for, like, people wanted them to acquire a chip company, and they pretty much said, no, we're not building a chip fab, and we're not acquiring a chip company. I think they were pretty clear about that. I'd say the downside, let me just be clear. The downside to me of them acquiring or investing even in mining is that ultimately mining is a lower margin business than selling EVs, and probably lower margin than selling Megapack. I don't know. Do you have any thoughts? Like, what are the margins on mining? I mean, right now, lithium.
Okay.
Right now, with lithium, apparently it's a really high margin, but that won't. That long run, that probably won't be sustained, or will it?
Well, so obviously, like if they were to buy out a miner, it would become a cost center, not a profit center, right? So, because they would be the only customer of their own operations now.
Well, it would be a cost center, but they have a cost center now of spending money on lithium.
Right.
So if
Yeah.
if it's a lower cost center of lithium, then ultimately it saves them money. But it may be that they produce enough lithium they can sell it to someone else. But I just think, what do you call that? There's some kind of accounting measure where you keep track of your transfer pricing, where you would sort of keep track of, what is this costing us? And you would say, all right, well, what would we have been spending on lithium if we weren't doing our own internal lithium?
Mhm.
I mean, I
Yeah.
guess if they did lithium clays in Nevada, that would still be a cost center.
Right. So that would be a cost center. But, again, like you're saying, like if it actually helps them, save money rather than to go through a third party provider of lithium, then that actually has its own ROIC built into it, right? That's a
Right.
return, that's a calculation that they'd have to do. So yeah, if it makes sense for them to do it, I mean, sure, I'd love that, right?
Yeah.
So like the point here is that like I see Tesla's balance sheet, and this is a chart of their invested capital, which is a measure of how big the balance sheet is. This is basically measuring how much total capital they have deployed since inception.
That 45 billion?
Yeah, so that's about 45 billion. Yeah. Now, that sounds like a lot, right? And it
Well,
is.
not in $1 trillion company, it doesn't.
Right, exactly. See, that's exactly the point. This is almost $1 trillion company, and yet they only have about 45 billion in total investments. So the market value relative to this total size of the balance sheet is much higher for Tesla than for any of other big tech companies that produce similar ROIC. For example, like I have two examples here, Amazon and Taiwan Semi. Their balance sheets are, almost 5 times bigger, right? Amazon's balance sheet is 250 billion. Taiwan Semi is 120 billion. So these two companies have deployed significantly more capital than Tesla
Right.
has so far, at least.
Right. Well, Amazon has all its warehouses, it has all its logistics operations. Taiwan Semi has these very capital intensive chip fabs, right?
Yeah, exactly.
But
Yeah.
you would think the largest auto factory in the North America would have been like a really big capital investment, and somehow, do we know how much it costs to build Giga Texas?
Um, it's not a lot. I mean, it's probably less than I think it's like
Maybe 2
around two
billion?
billion. Yeah.
Yeah.
Given the fact that their free cash flow accelerated
All right,
despite
I got to ask you
pushing
this
to.
now. How is it that Tesla's able to build these factories at such, 2 billion sounds like a lot of money, but for the size of the factory, it's not. How is it that Tesla's able to build these factories at such low cost?
It's classic iteration. I mean, they have learned lessons over 10 years on how to build electric cars. They made a lot of mistakes and they've learned from them.
Right.
So I think there's actually a tweet. I forgot who was on it, but like Elon Musk basically kind of laughed at Tesla's capital efficiency, and he's like, "Well, our capital efficiency was terrible in 2018,
Right.
right? And now it's completely different. You can see that number right here. where, the numbers were still negative, even though, Model 3 was ramping in Fremont. These were not very, eye-popping numbers. Like even if you're at 10% ROIC, big deal. Like you're not that great at
Right.
10%. It's tripled now to over 30, and I think it's going to go to 50
Right.
by the time Austin and Berlin are fully ramped. So it's just iteration, both on the factory side and on the vehicle design side. So the cars themselves are getting simpler to build, right? We know about that with the single piece die casting too. So, they're getting more and more efficient at, building the factory, and more efficient at building the car itself, at designing the car for the factory to build.
Okay, so I wanted to stress one other point. Let's suppose Tesla did a $10 billion stock buyback. That is roughly 1% of the float. That's not a meaningful impact on my stock price. That's a small effect.
It adds up over time. It's not a big.
Well, if
It's
they
not
do a
supposed
$10
to be
billion every year,
Yeah,
then 10 years later they've done 10%.
yeah,
Right? I get that. Although, of course, if the stock price goes up, they're not getting as much stock back. In other words, if the company goes to a $2 trillion market cap and they spend $10 billion on stock buyback, it doesn't get you very far. It becomes half the impact. So all right. I think we've established our disagreement. My attitude is having that free cash available for acquisitions or other investments is worth having, and surviving a recession is worth having on hand.
yeah,
And I get that the cash pile's growing, but I think there's plenty of room to grow. And I think I probably wouldn't be worried about the cash pile being too big till $50 billion or $100 billion. I'm guessing what you're thinking is at a certain point the cash pile gets big enough. It is, I don't know if problem is the right word, but it's not an efficient use of capital.
yeah, yeah. And look, I'm not proposing that we axe the cash in half, right, all at once. What I'm saying is that, start small and grow it from there, right? So at least get that program started.
What
And
is
especially now,
there?
like especially when the stock is down 50%, right?
Yeah, no. If you were going to do a stock buyback and you believe in the company, now's a good time to do it. Does it send a negative signal to? First of all, everything Tesla does seems to send a negative signal to Wall Street, right? If Tesla announced tomorrow that 4680 Model Y is going to sell for $50,000 with 400 miles of range, Wall Street would say, "Oh no, it's going to cut into sales of Model X."
Yeah.
Right? We've got to sell the stock. It's going to cut into sales of Model X. Like they only sell 10,000 Model X's a year. Who cares?
Right. Yeah.
Right? I'm going to feel bad about the Model X Plaid I'm buying in a few weeks, but I'll get over it.
Yeah.
All right.
I mean, look, it's not supposed to be instantaneous, like get rich overnight, right? Share buybacks are what companies do over like a decade.
Right.
But
But let me go back to that question. Do you think Wall Street would take it as a negative signal?
I do not. No, I don't.
Because you
will see media that makes it negative, like the media.
There's media that make everything negative.
Yeah, the media will make it negative, saying that that they don't, their best growth days are behind them. Kind of like what I started off.
It's a busted growth story.
It's a busted growth story, right? So that's what the media might start to say.
They're only going to build 5 more factories in the next year. It's a busted growth story.
Yeah. But you're going to attract a whole other class of investors when you do a consistent buyback.
Okay.
And it just basically rewards long-term shareholders. That's the idea behind it.
All right. I could ask you, do you want to talk about the ESG thing? Do you want to talk about the credit ratings? Is that, I mean,
yeah,
I think we've beaten the stock buyback topic to death. We could talk about those other topics, but I don't want to keep you up late if you got to move.
No, we could talk about that. Yeah.
So let's start with credit rating agencies. So as I see it, Tesla has this huge cash pile that's growing and they have no debt. It's absurd that they don't have an investment grade rating. And the excuses that S&P and Moody's make for not giving them an investment grade rating make absolutely no sense. What's your take on the failure to give Tesla an investment grade credit? Which for the audience, that investment grade credit rating matters because with the investment grade credit rating, there are institutional investors who don't invest in companies that don't have investment grade credit rating, and so you have less demand for the stock, and that keeps the stock price down. Am I getting that roughly right?
You're
So,
getting it right. Yeah. So it just
so
prevented certain investors from buying Tesla bonds.
what
Um,
about Tesla? Does it affect them buying Tesla stock?
it can. Some people do have some investment firms do have a mandate where they say they're not allowed to own junk rated equities.
Okay. So
So
what's your take on why they haven't given them investment grade credit rating yet?
so I'm trying to give them the benefit of the doubt as much as I possibly can. I think it's ridiculous that they still have it as junk. Um, because this chart alone is the reason why they should not be junk. They should be investment grade because they literally have more cash than they have debt. So it's almost a riskless investment if you're a investor in Tesla's bonds. For a company that has positive free cash flow and a net cash position, the debt is essentially risk-free, especially if it's senior secured debt, which a lot of it is or was before
Yeah.
Tesla paid most of it off.
Senior secured debt means the debt holders get paid before the shareholders,
Right.
before
Exactly.
anybody else, really.
Yeah. And it's collateralized by their factories, essentially.
Okay.
So, for a company that has a free cash flow trend that looks like this and, a net cash position that looks like this, I've never seen an example of a company that's continued to be rated junk when you have these two in
Yeah,
combination.
and not only that, but you look at its 7 quarters that they've had positive net cash,
Yeah, it's
and
been
it's
a while.
growing.
Yeah, it's exactly.
Right.
That's a good point. Like I would have said, all right, fine. Well, it takes a quarter or two to prove them out. Like let's say this to confirm the trend, maybe 3 quarters. I
Yeah.
mean, it's been a long time now. So and it just keeps growing.
Yeah.
Um, so I just don't get it. Like I think it's just what they want is more consistency. They're very like they're extremely old school in thinking, right?
Right.
They're not trying to rock the boat. They want businesses to prove their business models without a shadow of a doubt before they rate somebody investment grade.
Right. But at the same time, they don't downgrade somebody to junk when they no longer have a net cash position and they're heavily in debt and they've got all these problems, and there are companies that have investment grade credit rating that are in much worse position than Tesla.
Yeah.
Okay.
Yeah, the best example of that is Exxon Mobil, right? I was actually tweeting this a while back during the COVID crash, but Exxon Mobil continues to be rated investment grade even through the COVID crash. And it got really bad for Exxon. They were basically whistling past the graveyard in 2020. They had 3 billion in cash on the balance sheet. 3 billion for a company the size of Exxon. 3 billion in cash and 20 billion in debt coming due in the year 2020. And they had negative free cash flow after they paid dividends to shareholders. So this is a company that was essentially taking on debt to pay the dividend to shareholders. And you can see this through the data. I posted it a while back. Now the numbers since then have recovered dramatically for them because of the huge rebound in the oil price. So, their fortunes have turned quite dramatically, but if you're a Moody's or S&P, how do you sit through this and just hope and pray that their finances are just going to turn around suddenly?
Right.
They had to issue almost 20 billion in new debt in 2020 to pay off the old debt and to pay shareholders their dividend. So they're opening a new credit card to pay off an old credit card and just
Right.
hoping that, the price of oil rebounds so that they can finally get back to making money.
Okay.
That's a strategy that did end up working out, but as someone that works at the credit rating agencies to continue to rate their debt as investment grade, that is speculation. And
Right.
they
Right.
were literally speculating on Exxon recovering.
Right. So
I don't
you
see
ha-
how you can do that.
you have that, and then you have this ESG thing. So for people who aren't familiar with it, ESG is environmental, social, and governance. And Tesla was removed from S&P's ESG list while ExxonMobil is on the list. Tesla is probably the most environmentally friendly large company in the world, if not the most environmentally friendly company in the world. They I don't I there are media stories that are negative on Tesla in terms of social and governance, but there's not a lot of substance to those stories. And the S&P explanation for why Tesla was removed from the list was like, well, there were stories about racial harassment, and there's like stories in the media about racial harassment in the Fremont factories. Like, there's stories about racial harassment in every fact. The fact that the media plays up a Tesla story, it
Yeah.
doesn't mean there weren't racial discrimination lawsuits in General Motors factories or Ford factories. Just racial discrimination lawsuits against companies all the time.
Yeah.
So what's your thoughts about this ESG situation?
So ESG is a money making scheme, is what it is. These
Who makes
large,
who makes money on it?
for example, BlackRock. BlackRock, Larry Fink, CEO of BlackRock, he's been pushing this ESG stuff for years now. And so they have ETFs that are, ESG oriented, and they charge, a slight premium over their index ETFs, right? Index ETFs are very cheap now. So this is a way for BlackRock to be like, all right, well, let's figure out how to make more money. So they basically create this ESG index. And if you look at the list of companies that these ESG ETFs hold, it's basically just the S&P 500. You look at the top 10 holdings, it's barely anything different. So
Okay.
they basically kind of, reinvented the wheel, or like, just something old becomes new again, where, all right, we're going to stop calling this index, ETFs, and we're going to start calling this ESG. So people feel good about owning it rather than, feeling bad about owning companies that, destroy value on the planet.
So I talked
So,
to Alexandra a couple times recently, and we were talking about the credit rating agencies, and her opinion was, her description was, in the early days of like S&P or Moody's, people would go out in the field and look at companies and basically get information that wasn't really publicly accessible. It might not have been hidden from the public, but it wasn't easy to get to, and they would go out and they would actually look at the companies in person and get a feel for what they are, and then assign a credit rating because they had information the public didn't have. It seems like today the credit rating agencies are simply using publicly available information that you and I can access and investment analysts can access. So they're not really adding any value. They have their model and their opinion, but they're just assembling information the same way Pierre Farragut or Dan Ives does, or you do, or I do, and it's just, why is their opinion better than yours or Dan's or Pierre's?
right.
I mean,
So
is in a sense, are the credit rating agencies completely obsolete, or is there some value they still add?
I think they're just very risk averse. That's kind of their DNA. They don't want to issue an investment grade rating to a new upstart.
What I'm saying is, do
So,
they add value to the markets? I mean, the markets already, any investment analyst can look at whatever startup company and say, okay, I don't think that company's that reliable yet. I'm not going to invest in it. Does S&P or Moody's giving it an investment grade credit rating change an analyst's mind when they look and they see, well, they got a lot of debt, they don't have a lot of cash, and they got negative free cash flow? Is a positive rating from a credit agency going to change their mind? Or on the alternative, is a negative rating from the credit rating agency in the face of fast growth and good net cash position, other than Tesla being a special case because of the media attention? Um, is that going to discourage most investors from investing in a company just because it doesn't have? And that's my point. Is just, I think there's a lot of money spent on maintaining these credit ratings, and I don't know exactly how S&P and Moody's get paid,
so
but
yeah, they charge big bucks
they charge to who?
to asset management firms. So mutual fund companies, hedge funds, investment management firms of all types. They subscribe. They have to, pay to get these ratings, right? And to
Right.
get
So
their
then the question would be, if you were running a fund, why the hell would you pay S&P and Moody's for access to their data when they're just using you? They're using the same data you have, and they're offering an opinion.
Well, because not everybody has a staff full of, astute analysts, right? So there's an entire, like, group of, people out there, they're mostly called financial advisors, right? And their job is not to do deep dives into balance sheets and cash flow trends. Their job is to just advise individual clients on asset allocation, like where should you be, how should you be planning for retirement, things like that. So they don't have the time nor the skills to be able to look at companies and understand what their credit risk is. So that's where Moody's or S&P comes in, to be able to provide that type of
But
research.
are they providing valuable information to those
Right.
financial advisors? Are they
So in most
providing?
cases, well, so I would say in most cases, yes, but not in all cases.
Okay.
Not in all cases. So, like, obviously, they dropped the ball with Lehman Brothers in 2008, big time,
Yep.
and with most banks, really. And they took excessive risk, I think, with Exxon Mobil in 2019,
Sure.
2020,
But
and now with
but
Tesla.
okay, we've got like 10 examples when they were wrong, and
Mhm.
then there's maybe 500 examples where they're okay.
Yeah.
So maybe it's not. Maybe they're. It's not fair to call them completely obsolete. All right.
Right.
If your point is that there are investment advisors who are relying on this information and they don't have the, like you said, they don't have the time to research 500 companies or 1,000 companies to advise their clients where to invest. I guess that makes sense.
Yeah. And by the way, so the only people that this really screwed over are the investment firms that have a clear mandate that they have to only hold investment grade rated bonds for their clients.
But that's a fairly small portion of the market, right?
I mean, it's a pretty big portion of the market, but remember, the bond markets are priced based on supply and demand of people that are trading those bonds, right?
Right.
So, although Tesla's credit rating is still rated junk, the actual way to understand what the market is rating their debt is by looking at their bond yields and their
Right.
yield spreads. The spread to both the high yield index and the investment grade index. And they have a very, very small spread to the investment grade index right
So
now.
they're basically being treated as investment grade, even though they're not.
Exactly. Exactly. So the bond market has already figured this out. Bond traders, they
Right.
often say, are the smartest guys in the room. So they've already figured this out. So it's not like Tesla had to pay a way higher interest rate. I mean, initially they did when they issued these bonds. The bonds were issued quite a while ago, back when they were not cash flow positive. So they do have a high interest rate embedded into their bonds.
Yeah.
But that's why Zach has been so adamant about paying that debt back.
Your Twitter account is FreshJiva, FRESHJIVA.
Yeah.
That's your Twitter handle. So I'm going to put a link to that in the description below.
Thank you. Yeah. Also, by the way, I did join a YouTube channel called Plant Stock. So I'm kind of a regular.
Oh yeah, please also check out the YouTube channel Plant Stock Mayur and what's his name? Jeremy?
Jesse.
Jesse.
Yeah.
Mayur and Jesse have a channel called Plant Stock. I just interviewed them recently about that. Plant Stock talks about plant-based meat and maybe other topics related to that. So check out that channel. I'll put a link to that in the description below as well. But again, check out the t-shirts at elonbits.com. Support this channel on Locals, Patreon, YouTube channel members. Check out my other videos. And thank you so much for watching.